All right, guys, we need to talk about what just happened with the Federal Reserve because this is absolutely insane. If you've been paying attention to the markets over the last 48 hours, you know that something major just went down. The dollar is plummeting. Stocks are going parabolic. Gold just hit an all-time high. And crypto, Bitcoin specifically, just smashed through levels we haven't seen since the peak of the last bull run. I'm talking about a legitimate market earthquake that's happening right now. And if you're not paying attention, you could either miss out on massive gains or get absolutely wrecked if you don't understand what's really going on here. So in this video, I'm going to break down exactly what the Federal Reserve just did, why the dollar is collapsing, what this means for your investments in stocks, gold, and crypto, and most importantly, what you should be doing with your money right now to protect yourself and potentially profit from this chaos. I've been in real estate and investing for over a decade. I've seen multiple market cycles, and I can tell you with complete certainty that what we're witnessing right now is a pivotal moment that will affect your wealth for years to come. But before we dive in, if you appreciate videos like this where I break down complex financial news into actionable advice, do me a huge favor and smash that like button for the YouTube algorithm. It takes literally 1 second, it's completely free, and it helps this channel out tremendously. Also, subscribe if you haven't already, because I post videos like this constantly to help you build wealth and make smarter money decisions. All right, let's dive in. So here's what happened. On February 5th, 2026, the Federal Reserve held an emergency meeting. And yes, I'm using the word emergency because this wasn't a scheduled FOMC meeting. This was called suddenly, which immediately sent shockwaves through financial markets because emergency Fed meetings are rare and usually signal that something serious is going down. During this meeting, the Fed announced a massive policy shift that nobody saw coming. They didn't just cut interest rates. They announced a 75 basis point cut, dropping the federal funds rate from 4.5% down to 3.75% in one fell swoop. That's the biggest single rate cut we've seen since the financial crisis in 2008. But that's not all. The Fed also announced that they're restarting quantitative easing, QE, which essentially means they're going to start printing money again to buy government bonds and mortgage-backed securities. According to the statement released by Fed Chair Jerome Powell, they're committing to purchasing $120 billion per month in assets, which is the same scale we saw during the COVID pandemic in 2020. Now, why did they do this? Well, the official explanation from the Fed was that they're seeing significant deflationary pressures and economic contraction indicators that require immediate action to prevent a recession. Specifically, they pointed to recent data showing that consumer spending dropped 2.3% in January 2026, manufacturing output contracted for the third consecutive month, and unemployment ticked up from 3.7% to 4.2% in just 1 month. Powell said in the press conference, and I'm paraphrasing here, that the Fed needed to act decisively to support the economy and prevent a potential deflationary spiral. He mentioned concerns about commercial real estate defaults, consumer debt levels, and global economic slowdown, particularly in Europe and China. The goal, according to him, is to stimulate borrowing, encourage spending, and stabilize financial markets. Sounds reasonable on the surface, right? The Fed sees trouble ahead, so they're pulling out the big guns to prevent a recession. But here's where it gets interesting, and this is what most mainstream media isn't telling you. The market's reaction to this has been the exact opposite of what you'd expect if people actually believed the economy was in serious trouble. Let me show you what happened to the US dollar immediately after this announcement. The US dollar index, which measures the dollar against a basket of other currencies like the euro, yen, and pound, dropped 3.2% in 2 days. That might not sound like a lot, but for currency markets, that's a massive move. We're talking about the biggest 2-day drop in the dollar since March 2020 when COVID first hit. Why is this happening? Well, it's economics 101, guys. When the Federal Reserve cuts rates and prints money, the value of the dollar goes down. Think about it this way. If there is suddenly way more dollars in circulation because the Fed is creating them out of thin air to buy bonds, each individual dollar becomes less valuable. It's simple supply and demand. More supply of dollars equals lower value per dollar. But here's what's crazy. The dollar was already under pressure before this announcement. We've been seeing weakness for months because of ballooning government debt. The US national debt just crossed $36 trillion in January 2026, according to the Treasury Department, and concerns about the long-term sustainability of American fiscal policy. International investors have been slowly reducing their holdings of US Treasury bonds, with China and Japan both cutting their positions by a combined $180 billion over the last 6 months, according to Bloomberg data. So the Fed's announcement was basically gasoline on a fire that was already burning. Currency traders looked at this and said, okay, the Fed is devaluing the dollar on purpose to inflate away debt and stimulate the economy. I don't want to hold dollars if they're going to be worth less in 6 months. And boom, massive selling pressure. Now, here's what this means for you. If you're an American consumer, a weaker dollar makes everything you buy more expensive, especially imported goods. That means electronics, cars, clothing, food, all of it goes up in price because those products are either imported or made with imported materials. We're already seeing this play out. Gas prices jumped 8 cents per gallon in just 2 days, according to AAA, because oil is priced in dollars globally. And when the dollar falls, it takes more dollars to buy the same barrel of oil. But if you're an investor, a weaker dollar can actually be a huge opportunity. Which brings me to what's happening with stocks, gold, and crypto right now. Let's talk about the stock market, because this is where things get wild. The S&P 500 jumped 4.1% in the first trading session after the Fed announcement, the biggest single-day gain in over a year. The Nasdaq, which is tech-heavy, surged even more, up 5.3%. Dow Jones up 3.8%. Across the board, massive green candles. Now you might be thinking, wait, Graham, didn't the Fed just say the economy is in trouble? Why are stocks going up if we're headed for a recession? Great question. Here's the deal. The stock market isn't the economy. I know that sounds weird, but it's true. The stock market is forward-looking, meaning it's pricing in what investors think will happen in the future, not necessarily what's happening today. When the Fed cuts rates and restarts QE, that floods the financial system with liquidity. Banks have more money to lend, borrowing costs drop, and corporations can access cheap capital to buy back their own stock, invest in growth, or refinance debt at lower rates. All of that is extremely bullish for stock prices, even if the underlying economy is shaky. We saw this exact same playbook during COVID. The economy shut down, unemployment spiked to 14%, GDP contracted, but the stock market went on an absolute tear because the Fed printed trillions of dollars. Money has to go somewhere, and a lot of it flows into equities because bonds yield nothing when rates are low, and cash is losing value due to inflation. So investors pile into stocks as the least bad option. Right now, we're seeing the same dynamic. Tech stocks are leading the charge. Apple up 6%, Microsoft up 5.4%, Nvidia up 8.2%. Because tech companies benefit massively from low interest rates. Why? Because tech companies are valued based on future earnings. And when you discount those future earnings back to today using a lower interest rate, the present value goes up. It's a math thing, but the bottom line is lower rates equals higher tech valuations. But here's my take, and this is where I want you to pay close attention. Yes, stocks are ripping higher right now, and yes, you could make money riding this wave. But I'm cautious about chasing this rally for a few reasons. First, if the Fed is cutting rates this aggressively, they clearly see something broken in the economy. That doesn't just go away because they print money. We could be setting up for a situation where stocks rally short term, but then reality catches up and we see a nasty correction later this year. Second, inflation is going to come roaring back. I'm talking about real, painful, everyday inflation that hits your wallet. The Fed tried to bring inflation down from 9% in 2022 to around 3% by raising rates. Now they're reversing course and printing money again. That's how you get stagflation, slow economic growth combined with rising prices. And in that environment, stocks can struggle because corporate earnings get squeezed by higher costs while consumer demand weakens. So if you're investing in stocks right now, I would focus on sectors that do well in inflationary environments. Energy, commodities, real assets. I'd also be very selective about tech. Stick with the mega caps that have pricing power and strong cash flows. Avoid speculative garbage with no earnings. This is not the time to YOLO into meme stocks. All right, now let's talk about gold, because this is where things get really interesting. Gold just broke $2,900 per ounce for the first time in history. We're talking about a 7% move in 2 days, which for gold, a traditionally slow-moving asset, is absolutely massive. And it's not just gold. Silver is up 9%, platinum up 6%. Basically, every precious metal is screaming higher. Why? Because gold is the ultimate hedge against currency debasement and inflation. When people lose faith in fiat currency, which is exactly what's happening with the dollar right now, they run to hard assets that can't be printed by central banks. Gold has been money for thousands of years. You can't create more of it with a printing press. It's scarce, it's durable, and it's universally recognized as a store of value. Historically, gold performs incredibly well when the Fed is printing money and real interest rates are negative. What are real interest rates? It's the nominal interest rate minus inflation. So if the Fed cuts rates to 3.75%, but inflation is running at 4%, your real rate is negative 0.25%. That means you're actually losing purchasing power by holding cash or bonds, which makes gold extremely attractive. According to data from the World Gold Council, central banks around the world have been buying gold at record levels over the past 2 years. China, Russia, India, Turkey, they're all accumulating gold because they want to diversify away from the US dollar. This trend is accelerating now that the Fed is devaluing the dollar on purpose. Here's my personal take on gold. I've always been skeptical of gold as an investment because it doesn't produce cash flow, it doesn't pay dividends, and you're basically betting that someone will pay more for it in the future than you did today. But in an environment like this, where central banks are going full money printer mode and the dollar is tanking, gold makes sense as a portfolio allocation. I'm not saying go all in on gold, but having 5 to 10% of your portfolio in physical gold or a gold ETF like GLD is a smart hedge right now. One thing I'll warn you about, be careful with gold mining stocks. Yes, they can give you leveraged exposure to gold prices, but they also come with operational risks, geopolitical risks, and management risks. If you want pure gold exposure, stick with physical metal or ETFs that actually hold gold bullion. Now, the big story that everyone's talking about, crypto. Bitcoin just surged past $95,000, up 18% in 3 days. Ethereum is up 22%, hitting $4,800. Solana up 28%. Across the board, the entire crypto market is exploding higher, and the total market cap just crossed $3.5 trillion for the first time since early 2024. This is not a coincidence, guys. Crypto is behaving exactly like you'd expect when the Fed starts printing money and the dollar is collapsing. Bitcoin specifically was created in response to the 2008 financial crisis as a decentralized alternative to government-issued fiat currency. It has a hard cap of 21 million coins. No central bank can print more Bitcoin. That scarcity narrative is incredibly powerful right now. Think about it from an investor's perspective. If you believe the Fed is going to keep printing money, devaluing the dollar, and inflating away debt, where do you put your money? You look for assets that are scarce and can't be debased. Gold is one option. Bitcoin is another. And because Bitcoin is digital, easily transferable, and has a growing institutional adoption, a lot of investors, especially younger ones, are choosing crypto over gold. We're also seeing institutional demand pick up. According to Coinbase data, we've had net inflows of $4.2 billion into Bitcoin ETFs in just the last week. That's institutions, pension funds, and hedge funds buying Bitcoin exposure through regulated products. MicroStrategy, the publicly traded company that's basically a Bitcoin proxy, just announced they bought another 8,500 Bitcoin, bringing their total holdings to over 250,000 BTC. That's real money flowing into this space. But here's where I want to pump the brakes a little bit, because I know a lot of you watching this are thinking, Graham, should I buy Bitcoin right now? Should I mortgage my house and go all in? And my answer is absolutely not. Let me explain why. First, crypto is insanely volatile. Yes, Bitcoin is up 18% in 3 days, but it can also drop 20% in a week. We saw this in 2021 when Bitcoin hit $69,000, then crashed to $15,000 in 2022. If you're buying crypto, you need to be prepared for massive swings and only invest money you can afford to lose. Second, we could be seeing a short-term euphoria spike driven by Fed policy, but that doesn't mean it's sustainable. If the Fed reverses course, maybe they see inflation picking up too fast and they have to hike rates again, crypto could get crushed. It's happened before. Third, regulatory risk is still huge. The SEC is still figuring out how to regulate crypto, and there's always a chance of a crackdown, especially if crypto is being used to evade capital controls, or if there's a major scandal. That said, I do think crypto has a place in a diversified portfolio. I personally hold Bitcoin and Ethereum as a small percentage of my net worth, maybe 3 to 5%, because I believe in the long-term thesis of decentralized money, and I think the technology is here to stay. But I'm not betting the farm on it, and neither should you. If you're going to buy crypto, dollar cost average. Don't try to time the market. Buy a little bit every week or every month, and build your position over time. Use a platform like Coinbase or Kraken that's regulated and secure. And for the love of God, do not keep your crypto on an exchange long term. Move it to a hardware wallet like Ledger or Trezor where you control the private keys. All right, let's talk about what could go wrong with this thesis, because I always try to present both sides. Some people are arguing that the Fed's emergency rate cut is actually a sign of panic, not strength. If the economy is truly in trouble, if we're headed for a recession or even a depression, then stocks, gold, and crypto could all come crashing down as liquidity dries up and people rush to cash. There's also the argument that the Fed is trapped. If they keep printing money, inflation spirals out of control and they lose all credibility. But if they stop printing and raise rates again, they crash the economy and the markets. It's a lose-lose situation, and some analysts think we're heading for a major financial crisis no matter what the Fed does. Another risk, geopolitical chaos. If the dollar collapses too quickly, it could destabilize global trade, trigger currency wars, and lead to serious international conflict. Countries that hold massive amounts of US debt, like China and Japan, could dump their treasuries, which would spike interest rates and crash asset prices. And finally, there's the possibility that this whole rally is a bull trap. Maybe stocks, gold, and crypto rip higher for a few weeks, everyone gets euphoric, and then boom, reality hits, and everything crashes harder than before. We saw this in 2008 and in 2020. Dead cat bounces are real, and they can destroy portfolios if you're not careful. So yes, there are risks. There are always risks. But the key is to understand what's happening, position yourself intelligently, and don't get greedy. So here's my game plan, and this is what I'm doing with my own money. First, I'm holding a diversified portfolio. I'm not going all in on any one asset class. I've got stocks, mostly blue chip dividend pairs and some tech. I've got real estate, which is my bread and butter. I've got some gold as a hedge, and I've got a small allocation to crypto. Second, I'm keeping cash on hand. I know that sounds counterintuitive when the dollar is falling, but cash gives you optionality. If markets crash, I want to have dry powder to buy assets at a discount. If inflation keeps running, I can deploy that cash into inflation-protected assets. Third, I'm focusing on real assets, real estate, commodities, businesses that produce actual goods and services. These are things that hold value in inflationary environments. Paper assets, stocks, bonds, can get destroyed if inflation gets out of control. Fourth, I'm staying educated and nimble. Markets are moving fast right now. What's true today might not be true next month. I'm watching Fed announcements, economic data, and market technicals closely, and I'm ready to adjust my strategy if things change. And finally, I'm not panicking. Panic is the enemy of good decision making. Yes, the dollar is falling. Yes, the Fed is printing money. Yes, markets are going crazy. But this is not the end of the world. This is a financial cycle. And if you understand what's happening and position yourself correctly, you can come out ahead. If you're younger and have a long time horizon, keep investing consistently. Max out your 401k, max out your Roth IRA, buy index funds, and let compounding do its thing. If you're closer to retirement, talk to a financial advisor about adjusting your asset allocation to protect your wealth. And if you're an entrepreneur or business owner, think about how you can use this environment to your advantage. Low interest rates mean cheap capital. A weak dollar means US exports become more competitive. Inflation means you can raise prices. There are always opportunities if you know where to look. All right, guys, to wrap this up, the Federal Reserve just made a massive policy shift by cutting rates 75 basis points and restarting quantitative easing. The dollar is collapsing as a result, down over 3% in 2 days. Stocks are skyrocketing because liquidity is flooding the system. Gold just hit an all-time high because it's a hedge against currency debasement. And crypto is going parabolic because Bitcoin and Ethereum are seen as scarce digital alternatives to fiat money. This is a pivotal moment in financial markets, and how you respond will determine whether you build wealth or lose money over the next few years. My advice? Stay diversified, focus on real assets, keep some cash for opportunities, and don't get caught up in the hype. Markets are emotional right now, but your investment strategy should be rational and disciplined. If you found this video helpful, smash that like button. It genuinely helps the channel grow and lets me know you want more content like this. Subscribe if you haven't already, and drop a comment below letting me know what you think about the Fed's decision. Are you buying stocks, gold, crypto, or are you staying in cash? I read every comment and I love hearing your perspectives. Thanks so much for watching, and I'll see you in the next video.